of multiple prime brokers effectively lending and creating leverage potentially on the same instruments without knowing what the other one is doing. How do we fix that?
Let me speak generally, Andrew, about information that's available in the marketplace. What I think we've seen over the last 3 months or so with some of the so-called meme stocks and this situation is we do need to look at a modernization of the available information. For example, aggregate short positions. Should they really be 2 weeks delayed? In the case of positions that people are using so-called 13F reports for, those are quite delayed, and people are not using those reports for their intended purpose. They're using them for other purposes, but are we best serving those other purposes? Now, on swaps, Dodd-Frank, Title VII of Dodd-Frank put in place a swap regulatory regime. It took a long time for us, all of the regulators, to get together and get that into place. That actually comes into effect this November, and there will be much more reporting to the SEC and other authorities, the CFTC, around positions in swaps, how much capital, margining, how assets are segregated, and the like. So that is on the come. But Andrew, you're right to ask these questions because we should always be looking to modernize our disclosure system.
Were you surprised that certain banks were able to get out of these positions relatively unscathed, and yet others, like a Credit Suisse and Nomura, seem to be materially more challenged?
Look, I don't know enough about what was going on at each of these places to give you insight here. But what I did say at the outset, and I think you need to keep your eye on here, is when you have multiple parties involved in a situation like this, it does become more complex. Each party is acting in its own interest. They're supposed to do that, but it has an aggregate effect.
Right. I want to touch on financial literacy in just a moment, but I do want to get your thoughts on two other issues real quick, if I could. One is you and I have talked about Bitcoin for a very long time. You now have more and more banks offering it either through a Galaxy, Galaxy Digital kind of situation, or through a Grayscale or something else. Goldman Sachs planning to do something similar. None of this yet has been regulated in a meaningful way, and it feels like the SEC, at least when under your watch, had decided not to necessarily take a position on it. At what point do you think that regulators will have to take a position, if you will?
Well, Andrew, it depends. It depends on the character of the particular instrument you're discussing. Bitcoin was decided to be not a security before the time I got to the SEC, and therefore the SEC's jurisdiction over Bitcoin was rather indirect, in that its integration into the securities regulatory architecture. That does not mean that it should not be regulated. In fact, where digital assets land at the end of the day, which is very much a wide-ranging question, as you can tell from, just the opinions of you, Joe, and Becky, and the many guests you have on, will be driven in part by regulation, both domestic and international. And I expect, I'm just speaking as a citizen now, I expect that regulation will come in this area, both directly and indirectly, whether it's through how these are held at banks or securities accounts, taxation, and the like. I mean, we will see this regulatory environment involved, but it involves many different regulators, domestic and abroad.
Shepard Smith here. Thanks for watching CNBC on YouTube.